have taken all of the insightful questions, the pressing things on top of your mind that you'd like for us to address. And dozens and dozens of questions have come through, and we've done our best to group those into categories and seek to deliver the most impact possible that we can in today's presentation. So thank you again for joining us. My name is Katelynn Minott. I am a CPA, and I lead the team at BrightTax. We, as you may know, but you may be new to BrightTax, we are a remote tax preparation firm, a team of professionals that also lives around the world serving those with international circumstances. And this opportunity today is a moment where we're going to take some time to answer the pressing questions that you have about your own tax situation. Many of them the questions you've brought to the table today impact the tax situations of others and have a lot of value for us to answer in this group format. So we are going to do our best to work through as many questions as we can. My colleague Saki's just dropped a note in the chat to let you all know that we will be using the Q&A feature of the Zoom room today. So if you would like for us to answer questions that you have live, please drop them into the Q&A, and we'll be working to weave them into the presentation questions that have been provided as people registered with us for joining today. So I'm going to dive right in. Welcome and housekeeping. Some of the questions that were sent our way were actually about our recording. So if you have to drop off in the middle of the call today, for whatever reason, we will be sharing the recording after the fact. So don't worry about that. And anything that's not covered today, we will also make an effort to reach out to you individually and follow up to answer the questions for you, as we only have an hour and we have a lot to work through. One thing that I also want to make sure we get out of the way here early on is that we are a firm of US tax experts. And what that means is that we have a lot of experience working with clients in a variety of countries. And many of the questions that came our way actually are questions that would be better suited for tax professionals outside of the US with expertise in the countries that you either plan to move to or reside in currently. So what we're going to do is share with you a resource. It is the BrightTax Global Referral Network, and we'll also drop a link to that in the chat. So if your questions had to do with does Canada tax my pension? Or I'm retiring to Switzerland. What's included in the Swiss wealth tax? These are some of the examples of those questions that came our way. Will I own stamp duty if I sell my house in London? All of those questions should be addressed to a foreign tax professional. And the link in the chat will guide you to tax professionals and other professional service professionals that come highly recommended by our clients. So our clients have vetted and signed off on the positive experience that they've had with this group of people. And so if you use that link and access that network, you hopefully will be able to find a professional that can serve you and answer your questions on the non-US side of things. So with that said, let's move into one of the categories of the questions that was asked of us, and that was thresholds, deadlines, some of the costs associated with US tax filing. And I'm going to start with a question that came from Emily M. And the question is it true if we earn less than $50,000 a year, do we not have to file US taxes? And so I wanted to share with everybody here kind of the baseline for this conversation, and that is even if you live outside of the United States, you still have to file a US tax return as long as you've met the filing thresholds, and they're the same filing thresholds that apply to those who live in the States. A big misconception that we see is that people assume they earn not enough to have to file and that their threshold for filing actually changes when they move abroad. So I'll share some of the thresholds and for filing for 2025 with you here. If you are a single filer, your threshold is $15,750 US. And how you evaluate that threshold is based on your worldwide income. So when we're reporting and filing US taxes as a US citizen, as somebody who has a green card, a US taxpayer, you have to evaluate based on your worldwide income, not just your US source income. So that's a very common misconception and something that we find ourselves clarifying a lot. And it's what makes this part of US tax quite complex because lots of international tax systems and income types interact with the US system. So to answer the question from Emily very directly, even if you earn less than $50,000 a year, you probably have to still file U.S. taxes. In fact, if you are somebody who's married, filing separately from your spouse who's not a U.S. taxpayer, your filing threshold is just $5. So that's one that's going to be important to pay attention to as somebody who lives abroad and has international income that probably needs to be reported on your U.S. return. How do I even gather everything I need to file? Asks Cameron S. The US makes it complicated. That's absolutely true. And one of the big hurdles are things like different tax years. The UK, South Africa, New Zealand, these are all countries that have tax years that vary from the US. So the tax gathering, documentation gathering process can in fact be quite complicated. But if you keep in mind the fact that you need to report all of your worldwide income, any documentation that reflects the income and the taxes that you've paid abroad will be your key to a successful filing season in the US. We have a couple of other questions in similar. Manuel P asks, how do I make my US taxes from Spain easier? Maintaining good documentation, working with a Spanish tax professional who has familiarity with your circumstances as somebody who also files in the US is also important. And that referral network that we dropped a link to has a couple of those professionals that you might refer to. Deanne's S asks, are tax declarations still possible? And so what this question refers to is whether it's possible to paper file a US tax return still. The answer is yes. You can print out a PDF or your tax return and mail it into the IRS, but it's something we strongly recommend that you don't do because wait times for processing of IRS returns are extremely lengthy. We've seen processing of paper filed returns take up to 1 year. And those processing delays can cause all sorts of different headaches, whether you're seeking a tax transcript for proof of filing and other potential needs of a U.S. tax return might serve. It's really important that to the extent that you're able to electronically file your U.S. tax return, you do. Lisa asks, can you cover the filing dates? Which bank accounts have to be reported at what limits? And what French banks ask Americans for that they may not actually be required. So there's a bunch of questions captured in one here, and filing dates definitely apply to everyone. So we want to make sure we're super clear on this question. April 15th is the tax deadline that most people are familiar with because when you live stateside, April 15th is when you need to pay your tax bill and file your tax return. If you live outside of the United States, as of the 15th of April, your filing deadline is actually extended to June 15th, and your payment deadline is extended to June 15th. So as long as you file your tax return and pay your tax bill by June 15th, penalties do not apply. Again, as somebody who lives outside of the United States. You can apply for an additional extension to October 15th, and there is a final extension for those who live abroad to December 15th, which has to be requested by mail, and it's something that we do pretty frequently for clients who have a tax return in their foreign country that may not come in for quite some time, so they do need that extra time to file. Penalties for failure to pay start on June 15th, though. So you may not have a tax return that's due till October or December, but you still want to make sure your tax bill is paid, even as an estimated amount by June 15th to avoid that. Bank accounts that have to be reported. So you may or may not know about something called an FBAR, a foreign bank account report. And the FBAR is a disclosure in which any account that you have located outside of the United States will be reported each year to the US Treasury. The threshold for having to file this FBAR report is $10,000 US, and that's evaluated by summing the balance in all of your accounts outside of the United States. Which accounts have to be reported? From our perspective at BrightTax, anything with an account number is what we consider valid and required for purposes of an FBAR. There are some types of accounts that can be a gray area, but we always say when in doubt, file an FBAR, report it on the FBAR, because the FBAR doesn't drive any tax. It does have extremely high penalties associated with it, so it's not something you want to miss. Then the last component of this question is what French banks or foreign banks in general ask Americans for that they may not actually be required. More and more, we are having clients come to us letting us know that their foreign bank is asking for their social security number. And the reason for these requests is something called FATCA. And FATCA is essentially a series of agreements between the IRS and foreign banking institutions, and similarly, US banking institutions and foreign tax systems, in which they share or intend to share information. I have a client that will always stand out in my mind. Many years ago, he came to us. He was an accidental American, meaning he was born in the US, moved abroad at just a few weeks old, I think it was even. And at one point, his French bank came to him and said, "We need your social security number." Turns out he didn't have one. And we went through a lengthy process of supporting him in renouncing his citizenship ultimately in order to avoid the freeze that the French banks had put on his account. But that's a story that kind of emphasizes and reinforces that it's becoming more and more challenging for Americans to do banking outside of the US, simply because foreign banks have a lot of compliance requirements, including maintaining their social security numbers or ITINs to comply with these FATCA regulations. Stuart D asks, what roughly does a cross-border tax return cost? And this is a very complex question that is completely unique to your individual situation. At BrightTax, our beginning fee is $800, but that fee varies depending on the complexity of your own circumstance. In the slide that you see on your screen, there's a QR code, and the first step with our team is to meet us and do a full overview of your situation, answer all of the questions that you have based on your circumstance, and then we give you a clear upfront quote that is to prepare the tax return on your behalf. So every tax situation is different, and therefore the quote and the cost for filing it is different. But we like to get specific at the beginning of the engagement to make sure that you're not surprised down the line with any fees. All right. So Carissa V asks, I'm a US citizen living and working in Canada. Which country's taxes should I file first at tax time? This is a question we get a lot, not only for Canada-based clients, but those based in Portugal and many, many other countries where you have a foreign tax system that requires that you file in interaction with the US return. So said differently, as somebody who's a US citizen living and working in Canada, you have likely US interests, whether it be banking interests, maybe a pension, we see that a lot, maybe, but you also have income from Canada itself. And the fact that you have income from different sources makes the filing exercise a little bit more challenging, because Canada is going to want to give you credit for what you pay in the US, and vice versa. The US wants to give you tax credit for what you've paid in Canada. And so there's an interaction that has to take place between the two tax returns. The answer, again, like the previous question, is it depends, and you're going to get this answer a lot when it comes to taxes. Most often, your foreign tax return gets filed first, but that is not a blanket statement, and it's not always the case. So it'll depend on the sources of income that you have, where you're paying taxes, and that will determine where your tax return should be filed first. So we've talked a lot about thresholds, deadlines, the cost of filing, kind of the logistics of filing. And the next big category of questions that we got from the participants in our Q&A session today is what to do if you're behind on filing and need to catch up. So Mahir, I hope I'm pronouncing your name right, has the question, what happens if I haven't filed my US taxes for years, even though my income has been under the filing minimum? So there's two things here. The filing minimum applies regardless of where you live. So that's that standard deduction number, that filing threshold number that I mentioned, 15,000 for single filers, $5 for separate filers. If you're married filing jointly, it's as high as 31,500. If your income doesn't hit those thresholds, then you probably don't have to file. It's something you want to verify and make sure you're certain of, because there are some exceptions to those rules, such as if you have self-employment income. But if you haven't met the requirement for filing, then there's nothing to worry about. You don't need to go back and worry about catching up. But if you've learned that you do, in fact, have a requirement to file US taxes and you've not done so in many years, regardless of your income sources, regardless of your tax situation, if you have fallen out of compliance and your failure to file US tax returns was non-willful, meaning you're not intentionally hiding something from the IRS. The streamlined filing procedure is something that we do day in and day out. We've done thousands, I would say, over the past 14 or so years that I've been with Bright Tax. And it's a fantastic penalty-free way to get back into compliance. It requires that you just file 3 years. So I'll bring you the example of somebody who's lived abroad for 20 years and didn't realize until they opened their morning newspaper and saw that they do in fact have a US filing requirement. The streamlined procedure allows them just to file the past 3 years. So if we were to do this today, you would file 2025, 2024, and 2023, and you'd actually be deemed compliant for all of the years that you've missed over time. So it's a path forward. It's penalty free. It's focused and concentrated on just a few years. In addition to filing tax returns, it also requires that you submit those FBAR disclosures. The FBAR disclosure is that foreign bank account disclosure that I mentioned earlier. And that area in particular is one that has high penalty exposure and where the streamlined procedure really works to your benefit. So the streamlined procedure is kind of a no-brainer from our perspective and also in our experience. I can't think of any time in again, doing thousands of streamlined procedures over the course of our firm's history where the IRS has come back and rejected a streamlined procedure. So there's lots of different ways to get caught up in different types of filing requirements. But for somebody who resides outside of the US and hasn't filed, that one is a no-brainer. Dante B has a similar question. What if I forgot to file for 1 year while I'm abroad? And 1 year is a bit more of a specific situation. How you approach just correcting 1 year depends on kind of your penalty exposure. If the return has no complex international forms and no tax due, then there is the possibility of simply submitting the return and you'll probably not hear anything back from the IRS. That path is called a quiet disclosure. But if there's any risk of penalties or tax due on the return, there might be a different path forward. There's also penalty abatement opportunities if it's just the first time you failed to file and you have penalties attracted to your situation. But it can be as simple as just filing the return electronically and it's done with. But we would want to evaluate your situation and understand what the penalty exposure is before pursuing a path forward. Aziza has a similar question. I haven't filed since 2018. I was in school, I stayed, and haven't had steady work since. What happens now? Streamlined procedure is another great opportunity here. If somebody is working as a freelancer and in some countries where you perhaps have a self-employment tax liability that we would need to pay attention to, the streamlined procedure does that work of lifting the potential penalties for failure to file and pay penalties associated with those returns. Connie asks, my computer with my tax records was stolen years ago. Since then, I've sent the IRS estimates of what I owe, but I haven't actually filed. What do I need to do to make up the missed years? This is a complex situation. And the reality is that if you're making IRS estimates and you aren't filing a return, one of two things can happen. You could be carrying a balance, a refund balance due to you from the IRS. And at some point, they're likely to actually remit a check and or try and disperse those monies to you because the return isn't filed to reflect the amount that you actually owe. This is a unique individual situation, and depending on where you live and what tax records and or financial records might be able to be pulled from systems outside of your computer, there might be a way to reconstruct your situation and file the returns. But I would definitely seek the advice of a tax professional for this particular case, simply because reconstructing financial activity is not straightforward by any stretch of the imagination. Pat asks, we retired to Brazil on a permanent residency and stopped filing once we had no US salary. Do we need to notify anyone that you no longer live in the US? So this is a great question that also highlights that understanding that people often have, that they don't have to file once they've left the States. I've had many clients come to us and let me know that their tax professional in the US told them that they didn't have to file once they moved abroad. And the reality is that when you retire to Brazil, if you have US income or any income, whether it be from Brazil or from the US or any other country, you do still need to file and report that. So in retirement, that might be Social Security, that might be a pension distribution, a 401k distribution. You might have other financial activities in Brazil, investments. All of those things still need to be reported to the US each year. So in this case, I would recommend pursuing a streamlined procedure to make sure you're reporting that anything that was underreported during the time you've lived abroad. All right. So that brings us through what to do when you're behind, how to catch up. Now we're going to get a little bit more technical and we're going to start to talk about some of the tools that we can use to eliminate double taxation. So speaking in general terms, as US tax professionals who specialize in this international space, a lot of the work that we do is just eliminating the impact of double taxation, because we know that the US taxes your worldwide income, requires you to report it no matter where you live, no matter where your income comes from. And so what we often do is consider the taxes that you're paid in a foreign country or the fact that you're physically present outside of the US, and use those facts to eliminate your US liability as much as possible. So coming to this foreign earned income exclusion, foreign tax credit topic, which are the two big tools that we're using day in and day out as tax professionals to reduce the tax bill. The first question comes from Nicole P. And Nicole asks, I'm a US citizen in Nicaragua most of the year. Nicaragua does not tax foreign earned income and lets me exclude it. Do I end up paying no income tax at all? So this is a really interesting example of where somebody who lives outside of the US, in a country that doesn't tax their income that's US generated, is able to eliminate their worldwide tax liability to zero. So because Nicaragua is not taxing your income, you don't have what's called the foreign tax credit, but instead we use on the US tax return the foreign earned income exclusion. The foreign earned income exclusion allows you to eliminate about 130,000 of earned income, so wages, self-employment income, anything else that's actively generated from your taxable income. That can save about $17,000 per taxpayer per year. And in order to qualify for the foreign earned income exclusion, you either have to be a bona fide resident in a foreign country or be physically absent from the US for 330 days in the tax year. So in this case, what Nicole is doing is presumably earning income under that $130,000 threshold. She's using the Form 2555, the foreign earned income exclusion, to wipe out her tax liability. And so worldwide, she's not paying income tax at all. That is a viable strategy. It's probably sounding too good to be true, and it is in fact the correct way to file as long as you have qualified for the foreign earned income exclusion criteria, which is having a tax home abroad and either meeting the physical presence test or the bona fide residence test. Carrie asks a similar question about the foreign earned income exclusion. whether she can live in two countries outside of the US in the same year and still use it. And the answer is yes. I've actually done this myself. The year that I lived in Chile up until February and then moved to Brazil for the remainder of the year, I was able to take the foreign earned income exclusion for the entirety of the year, even though I was spending time in two different countries. In my case, I was using the physical presence test to meet it, but you could, in theory, have a bona fide residence test met because you're ending residency in one place and beginning residency in another. So multi-country circumstances does in fact qualify for the foreign exclusion. All right. Haley is sharing that 2026 is her last year abroad before moving overseas again in 2 to 3 years. What should I do now to protect my foreign exclusion and other benefits for when I go back? So if you have your final year abroad, you're ending the use of the foreign earned income exclusion because you no longer qualify for it. There's nothing that you need to do proactively to then again qualify it for the exclusion when you move again in the future. This question relates to the fact that you can optionally discontinue use of the foreign earned income exclusion, but in this case, you actually no longer qualify for the exclusion based on either of the tests. So there's nothing you need to do to protect that stance and use it again in the future. Alex C. asks the question, how long can I take the foreign tax credit and what happens after that? Can I still take it if I never use up the carry forward? So let me explain a little bit about what the foreign tax credit is, how it's used, and how it carries forward, as Alex implies. The foreign tax credit is a different tool that we use. I would say even more often the foreign earned income exclusion that we just talked about. The foreign tax credit allows us to take the tax that you've paid in the foreign country, whatever foreign country that might be, whether it's the one you reside in or another, and offset your US tax bill with it. So to provide a very simple example, if you live in France and earn $100,000 and are required to pay $30,000 in tax to France, the US tax bill is calculated to be $25,000. You can subtract the $30,000, which would completely offset your US tax bill of $25,000 and bring your US tax bill down to zero. So the carryover in this example is referring to the difference between your French tax bill and the US tax bill, which is that $5,000. The $5,000 is eligible to be carried forward for up to 10 years and offsetting future income should you have any income that you need to use the foreign tax credit on. If you never use it up within that 10-year period, it does in fact expire. There's nothing you can do to preserve it from there on. But the foreign tax credit does not depend on you spending a certain amount of time out overseas or you being a bona fide resident of another country. And it also doesn't apply only to earned income, but it applies to passive income as well. So if you have investments, if you have rental properties, if you have anything that is non-general category, meaning not a wage, not a self-employment income source, then this foreign tax credit is your tool. And it's our go-to. It's the one we use first. It's the one we try first. If it doesn't work, we try other mechanisms. But the foreign tax credit is definitely the most impactful tool that we have as tax professionals to eliminate double taxation. Mark asks how common it is to have a foreign tax credit carry forward. I wouldn't say it's statistically common or uncommon, but the bottom line is that if you are in a country where your tax rates are higher than the US, then you're going to have foreign tax credit carry forward. There's nothing wrong with that. It doesn't wave a red flag to the IRS. There's nothing to be concerned about. And it's shown on the next year's tax return as a table that shows the last 10 years, all of the carry forwards you've had. So it's a rolling forward of the credits that is used each and every year and continue to carry forward to the extent that it's unused. All right, so Jan asks about tax treaties. Tax treaties, the question is, how do I find out about tax treaties and how important are they if I can already take the foreign tax credit? So I've talked to you about the foreign earned income exclusion. I've talked to you about the foreign tax credit. And another big misconception that we see and hear is, well, there's a tax treaty in place between where I live and the US, so I don't have to file, right? The answer is no. Unfortunately, tax treaties almost never impact the way that you're filing. They can be valuable to an extent in certain types of income. Resourcing income that would otherwise be considered U.S. income is a common use of a tax treaty. When you have pensions, when you have retirement income, treaties are also often useful, but we always try and use the other tools that are available to us first, the foreign tax credit, the foreign exclusion. One of the biggest reasons that tax treaties are not always as valuable as we'd like them to be is something called a saving clause. A saving clause is essentially part of every single tax treaty that says the US can tax its citizens as if the treaty didn't exist in the first place. So, as you can imply, it essentially wipes out the usability of the tax treaty for anybody who has US citizenship, meaning the tax treaty can sometimes be beneficial for businesses. It can be sometimes beneficial for non-citizens, so green card holders and visa holders. And so ultimately, that's why it's not the first place we go when we're doing a tax return to eliminate double taxation. But again, it doesn't mean it's never valuable. It doesn't mean it can never be used. They're just very precise and specific areas in which that is the case. All right. Alexandra N asks, how do I get my US withholding close to my actual tax liability so I can avoid double taxation or a messy correction later? So essentially what Alexandra is pointing out is that as somebody who's filing a tax return in two different systems and also perhaps subject to withholding on the US side, to the extent that you can get the US tax withholding amount done accurately, you're going to avoid a big refund at the end of the year or tax due when April 15th or June 15th rolls around. So my best advice to Alexandra in this case is actually to have a tax projection prepared, which is essentially the same as tax preparation, but for the future state of your return. So if you know that for 2026, this is going to be what your income will look like, this is approximately your foreign tax rate, a tax projection can essentially show you what the bottom line, your actual tax liability is, and then you can have withholding set up to reflect that. That's a complex exercise that is essentially the same as a tax preparation exercise. And so, it does require the time and resources to essentially return the tax preparation proactively, which implies an expense and footwork. So you'll want to balance whether that actually makes sense, how important is it to you to get that precise in the withholding exercise. When in doubt, you can refer to last year's tax liability and use that as a safe harbor, use that as an estimation of what the future tax rates might look like on both sides. So that's the more practical approach, if you will. All right. Florence K asks, as a dual US UK citizen in London, how do I line up my UK taxes due January 1st with my US estimated taxes in April? Since I'll claim treaty relief, do I pay both and then request a refund? So Florence points out a couple of different complexities. And for those who are in the UK, you have an April tax year end, and in the US, we have a calendar year tax year. And lining up those two tax years can be very complicated, especially since, as Florence pointed out here, even though your April is when your tax year ends, often the tax return isn't filed until the following January. So for us as US tax professionals to take credit for what you've paid on the UK side, we need that information in hand, your final filing and the final calculations. Some people proactively pay both in advance and then request a refund where appropriate. It depends on how your foreign tax credit is being prepared on the US side. Almost always for UK taxpayers, we're using the foreign tax credit as your tax mechanism to reduce the double taxation. Um, but it'll depend on whether you're using the accrual method or the paid method. It is definitely a timing difference that's important, and the streams of your income in this case will be relevant as well. In the most simple cases, for somebody who is in the UK, if your income is just P60 income, wages income, in those cases we can use pay slips. But it sounds like here there's some treaty relief coming into play, so it's a bit more complex. And you'll want to have a conversation with somebody who can guide you in terms of those income sources and how important the corresponding tax returns need to be in synchronizing. All right, so we have Esther C. I'm a dual US Hungarian citizen moving back to Hungary. Most of my income is US source, but Hungary taxes my worldwide income and the treaty is ending. Can the foreign tax credit actually reduce my US tax if the income is US source? Um, this is an interesting one because, like I shared earlier, the treaty is often the key to resourcing income. I would want to know a little bit more about what your income sources are, simply because sometimes there are things that we assume are US source. I hear this often, very often, where people assume because my clients are in the US, because I'm getting paid in US dollars, because my US bank account is where the income is going, it's US sourced. But you might be surprised. An example of this that's super common and even, kind of challenging to wrap your mind around is capital gains from stocks, for example, follow your residency. So let's say I live in Hungary, I have US investments and capital gains generated from the stocks, even though they're in a US brokerage account and they're in US dollars. The fact that I am living in Hungary as a resident and subject to taxes there means that the capital gains associated with those shares is actually Hungarian source. So it's going to be a conversation about each of your income streams in this case and how we reduce the US tax related to each of them most effectively. Tracy L asks whether Italy's flat tax, now 300,000 euros, can be credited against US taxes. If I'm an Italian resident, but I keep a US domicile, do I owe Italian tax on my non-Italian income? So I can't answer the question of whether you owe Italian tax on your non-Italian income. That's a tax question for an Italian tax expert. But the Italian tax, as long as it's applied based on your income and is related to income that you have effectively generated, then generally speaking, the foreign tax credit can work. This one is quite a bit nuanced, more nuanced though. And again, we would want to understand the sources of your income, where the income is being generated to effectively understand whether the foreign tax credit can be used as a tool. All right, so I want to make sure we get some live questions in here. We have one coming through the Q&A area, and it is, I see the tax rate for non-residents in Australia is 32.5%. I'm moving there in August while continuing to work virtually in the US. Will I be double taxed since the US will be taxing my worldwide income? Is there a way to soften this big tax? This is a great question, and it perfectly highlights the sourcing misconceptions that I just pointed out. So, you are a US taxpayer moving to Australia, and let's say that your only income is your virtual work, right? So let's say you're either generating contractor income or you're a wage earner for a US company. In those activities, as a wage earner, as somebody who is generating personal services income, your source of income follows where you are physically sitting. So the day you get up from your chair in the US and sit down on a chair in Australia, your income becomes Australian sourced. And therefore, all of the income that you generate from the point you sit down in Australia to the end of the year, that is then subject to taxation in Australia, is considered Australian sourced income. Therefore, we can use the foreign tax credit to eliminate and probably completely wipe out your US tax liability. So if your tax rate in Australia is 32.5%, let's just guess, I don't know your income levels, but I'm just going to say perhaps your income tax rate in the US is 24% or 32%. In this case, we can use the foreign tax credit to wipe out your US tax bill, and therefore the double taxation goes away. So that example can be applied in many different ways and many different types and streams of income. But it's a great example of how the foreign tax credit won't even necessarily depend on the fact that you are a resident permanently in Australia, like the Foreign Earned Income Exclusion does. All right. Um, the next topic area that we got a lot of questions in is Roths, IRAs, 401ks, minimum distributions outside of the US. So we're already 40 minutes in. The time is flying by, and we're only about halfway through the questions, but I'm going to keep powering through to make sure we can get as much answered as possible. A lot of these questions related to foreign accounts, the questions are actually better suited for the foreign tax professional first. So want to just make sure that you keep that in mind, that especially as you're planning a move, thinking about moving abroad, often the best conversation that you can have first is with the foreign tax professional. The other part of these questions, so we have a question that is what's better, an RRSP or a 401k? Those questions are also better suited for financial advisors. So that global network, you will find a list of financial advisors who can give you that sort of investment savings planning advice that we can't unfortunately offer as tax professionals. But those in our global partner network have the cross-border experience. I know there's one in there that is specific to US, Canada. So tap into those resources and ask questions of those people, because those people can give you more guided advice on how to save and what is the best savings vehicle based on your situation. One question that Karen A asks is whether the US required minimum distributions rules still apply once I'm a Portuguese tax resident. The answer is yes. So RMD rules, the rules that say you have to take a certain amount out of your US-based retirement savings accounts don't change once you move outside of the US. So that's something to pay attention to. It's something that people get tripped up in a lot. So make sure to do those calculations and prepare that calculation and take the distribution despite the fact that you are living abroad. Themis P asks if I can keep contributing to US retirement accounts if I have a US company, but I'm a tax resident of another country. So the ability to contribute to US retirement accounts, the eligibility rules are basically the same, whether you're in the States or abroad. Now, the tools that I mentioned, such as the foreign earned income exclusion that we use to reduce your US tax liability, are often going to prevent you from being able to invest or contribute to a US retirement account. So the foreign earned income exclusion reduces your taxable income, and you have to have taxable income in order to make a contribution. That's, a very general blanket statement, but there are ways. So if you have a US company set up and you're an employee of that company, there are sometimes ways to make contributions, and you'll want to get strategic about that. The other really important consideration, however, is to understand how the other country, the country that you reside in that's taxing you also on your worldwide income, is treating those contributions and the retirement account itself. Because every single country is different. How they look at a 401k, how they look at a Roth account or an IRA is going to be different everywhere. So make sure you know what the implications of that account are before even moving in most cases. What you don't want it to be is a surprise that Canada doesn't recognize your Roth IRA account and therefore is going to be treating all of the earnings in that account as taxable, right? That would not be a welcome surprise. So proactive planning, especially with the insights of how your local country is treating those accounts, is going to be extremely important. Eric asks, as a dual US UK citizen living in the UK with a SEP IRA and a traditional IRA at Vanguard in the US, how will those be taxed? Well, I can't speak directly to how the UK taxes them. You'll need to have a conversation with a UK tax professional on those. I can share as a general piece of advice that we're seeing more and more US retirement account providers get a little bit finicky about having people who are US taxpayers invested in those accounts residing abroad for the same FATCA reasons that we talked earlier about, where the French bank has to share your information in theory back with the IRS. The reverse is true. So Vanguard in the US would, in theory, have to potentially share your information with the UK tax system. And to avoid the burdensome process of collecting all of your information, sharing that information, many financial institutions, retirement account providers are simply not allowing US citizens or US taxpayers outside of the US from participating. So just something to be careful about. What you don't want is, Fidelity to detect that you're logging in to your account from Argentina once a week, and therefore, their kind of alarm bells go off and they freeze your account on you. So just something to be cautious about as you think about moving outside of the US. The next area that I'm going to talk about today is owning a business and entity abroad. This is an area where we got a lot of questions. It's quite common, especially for people who reside outside of the US and are there for quite a long time. The everyday livelihood of somebody who's been abroad and been running a business for a long time, it makes sense that you would have an entity. And Ruth asks us to share a little bit more about expat taxes for a business on top of my personal taxes. So I'm going to start by just describing what it means to have a business as a US taxpayer, whether you're a citizen, a green card holder, or otherwise. As an individual taxpayer, you are required to report your foreign financial interests. And in addition to the accounts that we talked about reporting on an FBAR, you're also required to report ownership in any foreign entity. So to the extent that you have more than 10% in a foreign entity, you may have something called a 5471 requirement, an 8865 requirement to report your foreign company, your foreign partnership, and your participation in those. And to the extent that you're a majority owner of those entities, then the actual profits of those businesses can become subject to US tax. All of the forms that I'm describing here are extremely highly penalized if they're not filed on time. And I always revert back to that streamlined procedure, the penalty-free path forward. As somebody who has a foreign subsidiary, a foreign entity, operations outside of the US, big or small, are likely going to need to be reported to the IRS each year. So that's really important to look into. As an individual who has ownership in a foreign company, getting back into compliance is relatively straightforward. Where it becomes a little bit more complex and burdensome is if you have a US business that owns a foreign entity and those things are not being reported. But everything has a path forward to compliance. It's just important to do so proactively before the IRS approaches you first. Let's see. With respect to owning a business abroad, Joel W. asks, my wife is a green card and she just started a dog park business in Japan. We have homes in Japan and Arizona, and she also works online for a US employer. Does she have to declare the Japan business or can we leave it off? So I'm going to make the assumption that you live in Japan and that the business has become has been opened in Japan. So with the green card, you're taxed just like a citizen. You're required to report just like a citizen. What type of business and the kind of entity structure of that business is going to influence what disclosure is then required on the US return. Making the assumption that she's the owner and the majority owner, in other words, she owns more than 50% of the business, then she does in fact have to report and potentially even tax the profits of the business on the US return. The exception to that is if the business is taxed at a certain effective tax rate above 18.5%, if I'm not mistaken, in Japan. So there are exclusion or exemptions to this tax on the business profits to the extent that you're paying tax locally in Japan, which I assume is in fact the case. But to answer the question very simply, yeah, the Japanese business very likely needs to be disclosed, and you'll want to look into the correct disclosure associated with that based on the entity type. Carrie asks what the benefits of an offshore LLC for a US taxpayer are. This is a really great question, and there are lots of ways to structure businesses, and whether they're effective, whether they work for you, is going to depend on a ton of different factors. Where do you reside? Where is the work being carried out? What is the nature of the business? All of these questions can lead us towards an effective tax structuring exercise. In the global network, there is a resource. His name is Stuart Patton. I strongly suggest having a conversation with him if you would like to look at how to optimize your structure to take advantage of things like the foreign earned income exclusion. So one way an offshore LLC can make a lot of sense is if you have business activities that are currently self-employment activities, therefore you're subject to the 15.3 self-employment tax in the US. But you can, if the business activities are appropriate to facilitate then an offshore company, you can then pay yourself this foreign earned income exclusion, avoid the self-employment tax, and create efficiency around your business activities using an LLC. That's not the only way, and that method may not even be effective depending on what your effective tax rate is in the country you reside in. So we certainly defer to Stuart for his advice on how to structure entities best. But there are definitely ways to take advantage of offshore structuring to optimize your tax situation, right? It's important to be proactive and smart at the end of the day. All right. Moving on to foreign accounts, FBAR and FATCA. This is another category I want to make sure we touch on. We talked a little bit about what that FBAR means when you have $10,000 or more in accounts in total abroad, you need to report. Marian M asks about the joint checking account she holds with her German husband. Do I report just my half or the full balance? The answer is the full balance gets reported to the US Treasury on the FBAR, but there's a specific section that your account will go in that shows that it's jointly held. So in that case, it's very clear that it's not just your name on the account. If my foreign account only had a couple $100s in it all year, I don't need to report it, right? Asks Sandy C. In this case, to the extent that that's your only account, correct. You don't need to report an account with only $100. But if you have a second account with $10,000 in it and the account with $100 in it, they both get reported. So when you've hit the $10,000 threshold, all open accounts get reported. Looking at the other FBAR and FATCA accounts, if I missed a company retirement fund on my FBAR, is there any penalty for going back a few years to add it late? The IRS, up till about last week, if I'm not mistaken, had a program called the Delinquent FBAR Submission Procedures, which very clearly said all you need to do is submit your FBAR and penalties won't apply as long as you do it proactively. The IRS took this page down off their website, and they didn't really offer an explanation as far as I've seen. And yet we still encourage you to go back, report your FBAR, your retirement account on your FBAR. The reason for failure to file in this case would be you simply didn't know or you didn't have the information in hand. Those are all reasonable cause driving explanations. And in my experience, FBAR penalties are not something that a computer generates and they get slapped on. Certainly, if you Google FBAR penalties, you're going to find horror stories out there. But having done hundreds of thousands of FBARs over the course of my time with Bright Tax, I've never seen a penalty on an FBAR in practice. I've only seen an FBAR audit happen once, and it wasn't actually even an FBAR that Bright Tax prepared. It was a client who had self-prepared it before coming to us. But again, I've never seen these penalties occur in my experience of practice. That said, it doesn't mean they don't happen. It doesn't mean they don't occur, and I never say never, but it's pretty infrequent. So again, this reemphasizes the point that to the extent that you have missed FBAR accounts, proactively go back and make sure you're reporting them. Doesn't drive any tax. In our experience, it doesn't drive penalties, even though the forms themselves state that high penalties can in fact apply. Also related to foreign accounts, there's a topic that I also want to make sure we touch on very intentionally today, and that's called a PFIC. PFIC is we joke, the four-letter word of US tax, and it represents passive foreign investment company. A passive foreign investment company is essentially a pooled investment fund, such as a mutual fund, registered and regulated outside of the US. So if I'm somebody who lives in the States, I might open an account with Vanguard or Fidelity and invest in an index fund. And that is all well and good. The IRS regulates it. I get a 1099 at the end of the year. But to the extent that I am somebody who lives outside of the US, I may be doing the same activities. That might be my intuitive go-to way of investing. And unfortunately, the IRS regulates and requires reporting on these sorts of investments through this regime called the PFICs. And they're reported on something called the Form 8621. Basically, to the extent that you hold foreign or non-US mutual funds and or pooled investment funds, you have a requirement to disclose those investments. And then at the point where you're either receiving distributions from them via dividends or you're cashing out of them, realizing capital gains on them, the taxation of those investments is extremely high and punitive. More and more, we are seeing that there's awareness of these PFICs in general in the industry. And unfortunately, there's an extremely high burden for anybody who has a PFIC investment that we can help with getting compliant on. My high-level general advice as a non-financial advisor is that to the extent that you can avoid investing in what the IRS classifies as a PFIC, I would encourage you to do so. There are lots of gray areas in terms of what's considered a PFIC and what's not a PFIC. The easiest way that I have found to identify, especially with publicly traded funds, is what's called the ISIN number. It's the International Securities Identification Number, and it's the couple of letters at the beginning of that ISIN that shows you whether it's a U.S. fund that's regulated by the US or it's not. And to the extent that it's not, it's something that I would encourage you to look into, try to explore your options for divesting from those, and certainly make sure that you have, if necessary, the Form 8621 filing requirement as part of your US tax return. All right. That's PFICs. That's a very, very quick way to talk about PFICs. There are lots of other categories. We're getting down to the wire here with our time. So we only have 4 minutes. I'm going to kind of speed through some other areas. Renunciation and expatriation is a topic that came up a lot in the questions that we were asked. We are seeing an increasing number of expatriations, which is the decision that somebody takes to either give up their US passport or renounce or relinquish, I should say, their green card. Certainly, we're not seeing hundreds of these per year because I think the numbers of actual total renunciations from the US is only around 6,000 total around the world each year. But more and more people are looking at the burden of compliance, the burden of having to file a tax return, the fact that they are having trouble with foreign banking relationships, and the fact that they can't necessarily invest like they'd like to in mutual funds and other vehicles is leading people to the decision of renunciation. A couple of things to think about as you potentially explore that decision, which is an important one that definitely goes way beyond, the context of just taxes itself. But in order to give up a US passport, you have to have 5 years of compliance prior to that renunciation year. So, it's something of a catch-22. In order to get out of the tax filing requirement, you have to get into it first. And we often use the former procedures for former citizens as an avenue to get people caught up and out without a significant tax burden. So that's something to explore if you're giving it any serious attention. But overall, you do need to continue to file US tax returns regardless of where you live in the world. Whether you have dual passports, citizenship in another country, unfortunately, doesn't impact your requirement to file. Living abroad continues to attract this US tax filing requirement that you have. And being proactive is the best advice that I can provide across the board before making investment decisions, moving, all of these things to the extent that you properly vet and understand the US tax implications of them before embarking on a decision, then you will be well prepared and well organized for the paperwork requirement and the other elements of the decision that come your way. The last question I'm going to answer has to do with being self-employed outside of the US. If you work freelance from Ireland or any country, and you get paid by the US, do you have to submit a Schedule C and contribute to your Social Security? So, as somebody who's self-employed abroad, whether you have to submit and pay self-employment tax, which is also the same as your Social Security contribution, depends on whether you qualify for what's called a totalization agreement. The US has a variety of totalization agreements with foreign countries that says and seeks to eliminate the burden of double taxation as it relates to Social Security and Medicare. So, if you're somebody who's self-employed abroad, if you're paying into a foreign Social Security system, look into a totalization agreement as a potential way to avoid that tax. The Schedule C still needs to get submitted. Additionally, you might also have an 8858 requirement, which is what's called the foreign disregarded entity, because if you're working outside of the US, there's a strong probability that you're also running a business, even if informally outside of the US. But the fact that you get paid by a US entity, actually doesn't imply that your income is US sourced. Your income itself is foreign sourced. So we're at the top of the hour. I want to be respectful of everybody's time. We got through a ton today. There's a lot more to talk about. This webinar has been a great success. We will make every effort that we can to connect with each of you who submitted questions that we weren't able to answer today, and connect and get those answered for you. But the best resource that I can offer is a free introductory call with our client engagement team. The QR code here on the screen gives you a calendar where you can book a call. I think we even have appointments as soon as tomorrow, unless you've already booked them up during the course of this call. So reach out. We'd love to have a conversation with you, give you the answers to your questions, give you a path forward, and bring you the confidence that you need to move through this US tax filing requirement that you have with confidence each year. So thank you so much for joining us. We look forward to hopefully seeing you on a future webinar, and wish you the best in the rest of your week. Happy Wednesday, everyone.